Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this video, we're going to answer a very important question for a client. They wanted to generate $75,000 per year of after-tax income, inflation adjusted. We actually created two scenarios for the client. So one scenario uses the typical linear approach to the numbers. What's the average return on the portfolio? It's sort of a consistent number. What's the average inflation rate? That's a consistent number. And so the linear approach is very helpful when we're trying to compare different kinds of scenarios. But it really doesn't replicate the real world. The real world is quite variable. Inflation rates change, investment returns change, and in fact that variability can pose some risks for retirees. So we want to take a look at this client's scenario as it relates to not just the linear approach, but the variability of both return and inflation and how that impacts their financial planning. I think it's important we answer that question in advance of somebody retiring so they know how bulletproof their retirement plan is. Now, if you're new to our channel, make sure you hit the subscribe button so you're not missing future content. We're posting content all the time on various aspects of retirement planning and wealth planning. As well, if you go to the show notes, there's some great resources that you can access free of charge on retirement income planning, and you can find out how you can get your free retirement snapshot by going to our website. Okay, let's take a look at the scenario where the client wants to generate $75,000 per year of after-tax income. Okay, so let's take a look at some of the key assumptions we've used for this particular case study. So the case study is for Sam and Sally Sample, so we've changed the names to protect the innocent. Both Sam and Sally are going into their 66th year. So at age 65, they decided to transition into retirement. And they've been saving money to their RSP accounts as well as tax-free savings accounts. Both Sam and Sally have Canada Pension Plan benefits and old age security benefits, and I'll show you the numbers for their circumstances in a few minutes. In the base case analysis, we used a linear approach to both the inflation rate, we used 3% per year, and the investment return on the portfolio, we used 5% per year. So we were assuming that the clients were generating a 2% real return or after inflation return over the length of the analysis. As I mentioned at the beginning of the video, they wanted to generate $75,000 per year of after-tax income, and of course we inflation adjusted that at 3%. We assumed that tax brackets would be indexed at 3%, and we assumed that the government pensions would be indexed at 3% as well. Okay, let's first of all just take a look at their balance sheet, their financial assets, and their pensions. I'm going to show you some of the information we've entered on our financial planning software. So first of all, let's look at government pensions. So this is Canada Pension Plan for Sally, and you can see that Sally actually began taking her Canada Pension Plan early. She began taking it at age 63. So keep in mind, full retirement now for them is in their 66th year. They did go through a bit of a transition. They were doing some contract work, but she began taking her CPP benefits at 63. Her benefit amount is $67.82 per year. The qualified amount, she was at 51% of the CPP maximum when she made the application. Because she took it early, her benefit rate beginning at age 63 was 44% of the CPP maximum. And so she got $67.82, and that's indexed at 3% per year. Of course, the old age security benefits began at age 65. She's getting $84.98 per year, and that's indexed at 3%. Let's take a look at Sam's benefits. So Sam began taking benefits in his 65th year. His benefit is $13,170. He qualified for 85% of the CPP maximum. The benefit rate is indexed at 3%. Of course, he's getting his old age security benefits as well, and of course that's indexed at 3%. So those are their government pensions. So in addition to the government pensions, they've put together some investment assets as well. So let's take a look at that. So on their balance sheet, they have financial assets or capital assets such that there is $1.2 million, just over $1.2 million in total. That's broken down such that on the TFSA side, Sally has $104,000 of tax-free savings accounts. Sam does not have any TFSA money. And then on the RSP side, Sam has $650,352, and Sally has $450,000. So the total RSP value is $1.1 million. If we go to their real estate, they don't have any recreational property at this point, but they do have a residence that's valued at $710,000. Their total net worth right now is about 1.9, so just under $2 million of net worth position. Now let's take a look at the cash flow requirements. So this is what they've saved. Their goal was $75,000 per year. Let's see if they're on track for that particular cash flow goal that they have. Okay, so again, they wanted $75,000 per year, and we've indexed that at 3% per year. So this is their 66th year. By the time they get to age 70, that $75,000 per year of after-tax income is now just over $84,000 per year after tax because of the 3% inflation. By the time they get to age 80, that number is now $113,000 per year. So you can see that incrementally that cash flow requirement is going up every single year. Let's take a look at the cash flow requirement from a graph standpoint. So this chart will show us how that cash flow changes over time. Again, this is the $75,000 per year. And if we go along, again, you can see it's going up over time. By the time they get to their 95th year, $75,000 now is $176,742 per year of after-tax cash flow need. Now, again, you can argue that as they get older, there may be some plateauing in these expenses, and I think that's a legitimate comment. By inflation adjusting these numbers every single year, though, probably build some buffer into their planning. So it can be modeling this such that if they didn't have a constant increase of 3% per year, and if these expenses plateau because they're not traveling as much because discretionary expenses are going down, maybe you could justify that. The one caveat to that is maybe people will be experiencing higher healthcare costs when they get older. Okay, now that's the income requirement of $75,000. Let's take a look at their balance sheet. So what you see here is if they can generate a consistent return of 5% per year, 3% for inflation. The balance sheet shows us here, the dark blue is their home. That's never integrated into the cash flows. So that home value goes from approximately $721 by the end of this next year. By the time they get to age 95, it's now valued at about $1.1 million. Now the reality again is that principal residence will likely get sold at some point. So typically as people transition into their late 70s and 80s, or maybe moving into a condo or a life lease or apartment. So usually these assets get sold, but regardless, it never gets worked into the cash flows. The RSP RIF assets in the lighter blue look like they're fully depleted by about age 90, 91. Right? So the assets are slowly going down. We're killing the goose that lays the golden egg. And then the green represents the tax-free savings account, which continues to grow over time. And then in the latter years of their retirement, they're using their tax-free savings account to fund expenses for cash flow. So to summarize, in this scenario, they are killing the goose slowly that lays the golden egg, so that by the time they get to their 95th year, theoretically, the majority, if not all, of their financial assets are fully depleted. If they live past age 95, then at that point they would have to work into their situation home equity value. Now, they probably would have sold their home by then, so that equity probably is available. But they know, using relatively conservative assumptions, that they seem to be on track to funding their long-term retirement. So in this scenario, if you take a look at their balance sheet, let's just take a look at their net worth statement again. So again, here's their net worth, and you can see that the capital that they've built up is $1.2 million, just over $1.2 million. So in their 66th year, they wanted to generate $75,000 per year of after-tax income, index at 3% per year. Well, if they have $1.2 million in their investments, that is sufficient to generate that level of income. But they have to be comfortable with the idea that they are killing the goose that lays the golden egg slowly over time, so that by their 95th year, at least based on this analysis, there's no financial capital left. Now, this is where you get into different iterations. If they said to me, well, our goal is to have an asset base over and above our home to pass on to charities or our children, then we have to do some different modeling. We have to look at different kinds of expense requirements to have more value in the later stages of life if those particular priorities are important to them. And that's the value of these scenarios. So again, if you go to the show notes, you can find out how you can get a complimentary financial snapshot like this so you can begin planning out your own retirement. Now, the next analysis we want to take a look at is an analysis where we look at variability of return. And what can that do in terms of their overall planning? So let's take a look at that. So what we're going to take a look at, we have something called the randomized scenario. And this scenario planning basically takes 101 different scenarios and looks at the return ranges of three major asset classes. And so the asset classes we're using in this analysis would be 10% cash, 40% fixed income, 50% equities or stocks. So we're looking at a balanced portfolio. And if you look at the historical averages, so if you look at the average annual rates of return for the entire projection period, so this is over a 30-year period, the average came in at about 5.18% nominal return, so the gross return, and the after inflation return over that same time period was about 2.11%. So that's pretty consistent with the linear approach that we used. But what I'm going to do is I'm going to stress test their financial plan. So we're going to take a look at the worst case scenario and then update the analysis. And we're going to say, what if they're just really unfortunate and they transition into the worst period over that cycle, and how bulletproof is their financial planning? So we've updated it so that this isn't great. The nominal return was 2.45% per year, and on an after inflation basis, the real return was minus 0.99%. So there have been periods when the markets have not cooperated, particularly on the equity side. And so in this scenario, what does their situation look like? So this is worst case. Again, we'll apply and run this scenario for them. And then we're going to take a look at the same reports that I ran before. So we didn't change their cash flow need. We maintained a cash flow requirement of $75,000 per year in after-tax cash flows. Let's take a look at the charts. Now, if you look at the charts, they're quite a bit different. You can see that, again, the real estate values were never worked into the analysis, but their portfolio itself, if they kept spending at that $75,000 per year, came under quite a bit of pressure, so that by the time they got into their mid-80s, it was almost fully depleted. And then at the back end of this report, you can see that in the chart, this red, and that's a calculation of the growing deficits. So if they lived to age 95, kept spending at $75,000 per year, they're now having to use the equity from real estate to keep funding those expenses. So what that means is this red, in the first year, they've got a deficit of $63,000, accumulated deficit of $157,000. By their 92nd year, they've got an accumulated deficit of $373,000. And by age 95, they've got an accumulated deficit of $770,000. So their home value at that point is at $1.1 million, and the deficit in cash flow is $770,000. They still have a net worth position of $339,000. But what this tells you is that they would have to deplete equity from real assets to keep spending at this rate. Now, again, that's worst case scenario, and it shows the clients that they have conceivably the ability to even get through the worst case in this situation. Now, this is not ideal, and this gets us into discussions about how we can build portfolios to defend ourselves against variability of return. In other videos, we talked about timeline investing, cash wedge investing, or income wedge strategies for portfolios. Now, before we leave these charts, I just want to show you again, when we talk about variability, remember the first scenario, we used 5% on average forever and a day, 3% inflation forever and a day. So we want to model a more reality, which is variability. So this is the inflation rate. You can see the variability here, 2.8, 4.4, 1.63, 1.53, 2.1, 4.67, 4.05. So we're building in that inflation rate variability. If we go to return, you can see that it's minus 4.91, 12.3, 1.65, minus 2.4, 2.3, 0.45, 17.41, 1.26, 7.52, 8.4, 9.3, minus 10.86. Again, you get the basic idea here. So these randomized variable return scenarios are very helpful because we do have to worry about deaccumulation risk. And as we draw money consistently from a portfolio, clients don't want the income piece to be variable. They want that to be consistent so they can budget around that. But as they're drawing income from their portfolio, there is variability in investment markets and economies and inflation rates that they have to worry about. So worst case for these clients, they could still deal with it, but they may begin to rethink some of the planning. So it's ideal to do some of this planning well in advance of retirement, so you can run the different scenarios. And for some folks, it might be, well, maybe we need to save a little bit more. Maybe we need to do some other things before we get to retirement to deal with worst case scenarios. So there are ways of dealing with worst case, because what happens with worst case, if you don't set up the portfolio properly, you end up depleting assets at the wrong time, sometimes selling assets at a loss to keep funding the cash flow requirement. Again, the cash flow looks quite a bit different. Remember the previous one, they were fully funding, that was blue all the way along. Now we've got these deficit numbers every single year, beginning basically in the 89th year onward. Anyway, that is the overall analysis that I wanted to give you in terms of the scenario planning. Now, this is for a couple situation. We'll do others for single individuals, but I hope that's helpful to you. Again, if you go to the show notes, you'll find some links to some free educational resources back to our website on our homepage. If you'd like to get an analysis like this, again, there's a link to the website, and you can find out how you can get a complimentary financial analysis on your own retirement income planning. And if you haven't subscribed yet, make sure you do that. And I wish you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.